Something just happened in the gold and silver market that most investors will completely miss. It's not a headline, it's not a single price spike, it's a pattern. And veteran traders who have watched these markets for decades are calling it one of the rarest setups they have seen in their entire careers. If you own gold, if you own silver, or if you're sitting on the sidelines wondering when to make your move, give me the next 20 minutes, because what I'm about to show you has only happened a couple of times in the last 40 years, and both times it changed everything for the people who understood it early. Welcome back to Silver and Gold Watch. Today, we're diving into something bigger than a normal daily price update. We're looking at a structural shift happening right underneath the surface of these markets. Something most financial channels won't even mention. Let's get into it. Right now, gold is trading above $4,000 an ounce. It's sitting near a 7-week high. Silver just pushed towards $62 an ounce. That's the strongest level silver has touched since June. On the surface, that just looks like another strong week for precious metals. But when you look closer at the mechanics behind this move, something far more unusual is taking shape. Here's the piece almost nobody is talking about. The relationship between gold and silver right now is behaving in a way that veteran analysts say has only shown up a handful of times across the past several decades. Most recently, something similar unfolded during the 2008 financial crisis aftermath, and again during the extreme volatility of 2020. Both moments shared one very specific fingerprint. Silver beginning to outperform gold sharply, while the broader ratio between the two metals compressed at unusual speed. That exact fingerprint is showing up again right now. Let me explain what that actually means in plain terms. There's a measurement traders use called the gold to silver ratio. It simply tells you how many ounces of silver it takes to buy 1 ounce of gold. For most of modern history, that ratio has bounced somewhere between 40 and 80. When the ratio sits high, it means silver is cheap compared to gold. When the ratio drops fast, it usually means silver is catching up in a hurry. Right now that ratio is compressing quickly. It's fallen well below the historical average, and the speed of that drop is what has longtime traders paying close attention. Why does this matter so much? Because throughout history, extreme readings on this ratio have often marked turning points. Not the end of a move, often the acceleration point of one. When the ratio spiked above 120 during the 2020 market panic, silver was trading near $12 an ounce. Within months, silver rallied dramatically as the ratio snapped back toward normal levels. History doesn't repeat exactly, but it often rhymes, and right now the rhyme is getting louder. So what's actually fueling this move underneath the surface? Let's start with silver's supply story, because this is the part most casual investors have never even heard of. Silver has now run a supply deficit for 6 consecutive years. That means the world is consuming more silver than miners are pulling out of the ground year after year after year. This year's deficit is projected to be even larger than last year's. Above-ground stockpiles that used to cushion the market have been drawn down significantly since 2021. When you combine a shrinking supply cushion with rising demand, you get a market that becomes increasingly sensitive to even small shifts in buying pressure. And demand for silver isn't just coming from investors buying coins and bars. A huge portion of silver demand today comes from industrial use, solar panel manufacturing, electric vehicle production, semiconductors, artificial intelligence infrastructure that requires enormous amounts of electrical conductivity. Silver happens to be the best conductor of electricity of any metal on Earth. As the world builds out more clean energy and more advanced technology, silver demand keeps climbing structurally. That's very different from a short-term speculative rally. This is a demand story with real physical roots. Now let's bring gold back into the picture, because gold is telling its own important story right now. Gold's strength recently has been closely tied to shifting expectations around the Federal Reserve. Just a short time ago, markets were pricing in multiple interest rate hikes before year-end. That number has come down sharply. Falling energy prices tied to easing tension in the Middle East have reduced fears that inflation will keep accelerating. Lower inflation fears usually mean less pressure on the Federal Reserve to keep raising rates. And when rate hike expectations fade, gold tends to benefit because it doesn't compete well against high-yielding assets. Once that competition eases, gold becomes far more attractive again. There's also weaker labor market data adding fuel to this shift. Recent private sector job growth came in well below expectations. That's typically a signal of a cooling economy, A cooling economy often means a central bank has less justification to keep monetary policy tight. All of this together builds a case for gold that has nothing to do with panic and everything to do with shifting monetary expectations. But here's where it gets even more interesting. Not every voice at the Federal Reserve agrees rate hikes are done. One Fed governor pushed back publicly just this week, saying the central bank may still need to raise rates further if inflation doesn't continue cooling as expected. That kind of internal disagreement creates real uncertainty. And markets often respond to uncertainty by increasing demand for assets that don't depend on any single institution's decision-making. Gold has filled that role for centuries. Now let's talk about the buyers most people never think about. Central banks. While retail investors debate whether to buy an ounce here or there, central banks around the world have already been positioning for years. Recent data shows major institutional investors, particularly out of Asia, continuing to increase their exposure to gold-backed assets. This isn't emotional buying. This is long-term strategic accumulation designed to hedge against currency risk and global instability. Central bank demand tends to provide a steady structural floor underneath the gold market that retail sentiment alone could never create. There's one more piece of this puzzle that deserves your full attention: currency stability. Just recently, the United States and Japan coordinated a currency intervention to help stabilize a weakening yen. Coordinated interventions like this are extremely rare. They typically only happen when policymakers are seriously concerned about broader currency stability. When confidence in paper currencies shows even small cracks, history shows investors instinctively look toward gold and silver as an alternative store of value. That instinct has repeated itself across nearly every major currency crisis of the last century. So let's connect all of these threads together, because this is where the bigger picture becomes clear. You have a Federal Reserve caught between two competing signals: cooling inflation data pointing toward fewer rate hikes, and internal officials warning that hikes could still return if inflation doesn't behave. You have a labor market showing clear signs of softening. You have central banks quietly accumulating gold at a steady pace. You have a rare coordinated currency intervention signaling deeper concerns about global currency stability. And underneath all of that, you have silver sitting on top of a 6-year supply deficit while industrial demand for the metal keeps climbing structurally. Individually, any one of these forces would matter. Together, they're creating the kind of alignment that veteran traders say they have only witnessed a couple of times across their entire careers. This is exactly why the ratio between gold and silver is compressing the way it is right now. Silver is catching up, and it's catching up fast. Some analysts have described the current setup using statistical language borrowed from advanced market analysis. Extreme readings that fall multiple standard deviations outside the historical norm. In simpler terms, that means the current relationship between these two metals is stretched far outside what normal market behavior typically looks like. Stretched conditions like this don't last forever. Eventually they resolve, and when they resolve, they often do so with force. Now, I want to be very clear about something important. Rare setups like this don't guarantee a specific outcome. Markets are never guaranteed. What history does show is that when this many structural and macroeconomic forces line up at the same time, volatility tends to increase significantly in both directions. That means the potential for strong upward moves, but it also means the potential for sharp pullbacks along the way. Understanding that reality matters just as much as understanding the bullish case. Let's talk about what could challenge this setup, because a balanced view matters here. If upcoming inflation data comes in hotter than expected, the Federal Reserve could reverse course and lean back toward additional rate hikes. That would likely pressure both gold and silver in the short term. If diplomatic tensions in the Middle East resurface and oil prices spike back higher, that could reignite inflation concerns just as quickly as they eased. And if industrial demand for silver slows due to a broader economic slowdown, that structural demand story could weaken somewhat. Markets move in both directions, and staying aware of the risks protects you just as much as understanding the opportunity. So what does all of this actually mean for you? If you're already holding gold or silver, understanding these underlying forces gives you the ability to interpret daily price swings with far more confidence. Instead of reacting emotionally to every red or green candle on a chart, you can recognize whether short-term moves fit within this bigger structural story or represent something that genuinely changes the picture. If you're considering entering the market for the first time, understanding a setup like this helps you approach your decision with information instead of fear or hype. Rare alignments like this don't appear often. When they do, they tend to attract attention specifically because of how uncommon they are. Something worth remembering. The people who recognize similar setups during previous rare alignments in decades past were rarely the loudest voices in the room. They were usually the ones paying close attention to the underlying mechanics rather than the daily headlines. Supply deficits, ratio compression, central bank behavior, currency stability concerns. These are the signals that tend to matter most over the long run, even when short-term price action looks noisy or unpredictable. As we move forward, keep your eyes on a few specific things. Watch how the Federal Reserve handles its next major decision, because that single event could shift sentiment quickly in either direction. Watch incoming inflation and employment data, because both feed directly into how aggressive or patient the central bank chooses to be. Watch the gold-to-silver ratio itself, because continued compression would reinforce the idea that silver still has room to catch up relative to gold. And keep watching central bank buying activity, because sustained accumulation there tends to reflect long-term confidence that goes far beyond short-term headlines. Markets rarely announce major shifts with a bold, flashing sign. They usually reveal themselves through patterns like the one we just walked through together. Small signals stacking on top of each other until the picture becomes impossible to ignore. That's exactly what appears to be happening across gold and silver right now. And that's exactly why this moment deserves your full attention rather than a passing glance. If this video helped you understand what's really happening beneath the surface of these markets, make sure you hit that like button right now. It genuinely helps this channel reach more people who need to see this information before making decisions with their own money. If you haven't subscribed yet, this is the perfect time to do it, because we cover moments like this the moment they develop, not days later after the opportunity has already passed. And I want to hear directly from you. Drop a comment below and tell me this. Do you believe this rare alignment plays out the way history suggests it might, or do you think this time is different? I read every comment, and I'll be responding to as many as I can. Thank you for watching Silver and Gold Watch. Stay sharp, stay informed, and I'll see you in the next video.